In 1952, Harry Markowitz gave finance a machine. The machine had one job. It took a list of assets, their expected returns, their risks, and their correlations. Then it found the mix that gave the best trade-off between return and risk. That idea became modern portfolio theory. It became CFA curriculum. It became the language of pension funds, target date funds, and wealth managers. Then came a brutal claim. In 2009, Victor de Miguel, Lorenzo Garlapi, and Rahman Upal tested many optimized portfolios against the simplest rule possible. If there are n assets, put 1 over n in each. 10 assets means 10% each. 20 assets means 5% each. No forecasts. No covariance matrix. No math beyond division. Their result looked devastating. Equal weight was hard to beat. They argued that a classical optimizer might need hundreds of years of return data to win reliably. For a moment, it looked like the most famous machine in finance had lost to a coin flip. 1 year later, Mark Kritzman, Sebastian Page, and David Turkington answered in the Financial Analysts Journal. Their title was blunt. In Defense of Optimization, the Fallacy of 1 over n. Their message was not that optimization is magic. It was sharper than that. The machine was not broken. The input pipe was broken. Start with a concrete portfolio. Imagine 10 ETFs. One owns U.S. stocks. One owns international stocks. One owns treasury bonds. One owns corporate credit. One owns real estate. One owns commodities. The rest hold factor strategies. The 1 over n rule says this is easy. Put 10% in each ETF. That feels fair. It feels humble. It does not pretend to forecast the future. But it misses a basic fact. Some assets are close cousins. Others are strangers. 2 stock funds may fall together. Treasury bonds may rise when stocks fall. Commodities may move for a different reason. Real estate may look different on paper, then behave like stocks when credit tightens. Equal weight treats every box as equally different. The optimizer asks a better question. Which mix makes the whole portfolio less fragile? That question matters because investors do not only own assets, they own interactions. They own the way assets move together in bad months. The hard part is that an optimizer needs inputs. Some inputs are useful, some are poison. Expected return is the most dangerous input. It asks what each asset will earn. That number is noisy. A 5-year stock return can look great because the last 5 years were lucky. A 5-year bond return can look great because rates fell. If those recent returns become forecasts, the optimizer chases yesterday. That is how a good machine produces a bad portfolio. Here is the mistake in kitchen table terms. Suppose the last 5 years were great for technology stocks. Then, a short-term forecast says technology has the highest expected return. The optimizer sees that number and does what it was asked to do. It buys a lot of technology, maybe too much. Now suppose the last 5 years were great for bonds because interest rates fell. The same machine tilts toward bonds. Again, it is not being foolish. It is obeying a foolish input. The equal weight rule avoids this trap because it refuses to forecast. That is its strength. But it also refuses to learn from risk. That is its weakness. If 2 assets usually crash together, equal weight does not care. If 2 assets hedge each other, equal weight does not care. If one asset adds the same return with much less risk, equal weight does not care. It is humble. It is also blind. Kritzman, Page, and Turkington did not defend optimization with a toy example. They built a large test. Their study covered 13 datasets. Those datasets contained 1,028 data series. The authors built more than 50,000 optimized portfolios. Then they compared those portfolios out of sample against the market portfolio and the 1 over n portfolio. Out of sample means the optimizer picked weights first. Then the researchers tested those weights on later returns. That is the right standard. A portfolio method should not only explain the past, it should survive the next period. They tested 3 simple optimization approaches. First, minimum variance. This approach ignores expected returns. It only asks for the lowest risk mix, using how assets move together. Second, long sample expected returns. For each asset, the authors estimated a risk premium over a long sample before the backtest started. Then, they held that assumption steady. Third, growing sample estimates. This approach starts with available data and keeps adding more as time passes. The key choice was what they avoided. They did not rely on rolling short-term return averages as forecasts. A rolling 5-year average can say cash should beat stocks, simply because cash beats stocks in one strange window. That is not an economic forecast. It is a recent memory dressed up as a model. Their test asked a cleaner question. If the inputs are naive but plausible, does optimization still add value? The answer was yes. Across 13 datasets and more than 50,000 portfolios, optimized portfolios usually beat equal-weight portfolios out of sample. The strongest result was also the simplest. Minimum variance often beat 1 over n, even though it used no expected return forecast at all. That point matters. It means the covariance matrix alone had useful information. A covariance matrix is a table of relationships. It tells us which assets move together, which assets move apart, and which assets mostly ignore each other. The pattern of risks and correlations was enough to improve the portfolio. So the earlier case against optimization had aimed at the wrong target. It showed that short-term return forecasts are dangerous. It did not show that optimization is useless. Kritzman, Page, and Turkington argued that the apparent superiority of 1 over n came from implausible expectations created by rolling short-term samples. In plain English, the optimizer was being fed bad guesses. The equal weight rule won because it did not eat the bad guesses. But when the expected return inputs were long-term, stable, or simply plausible, the optimizer won. This is the core lesson. Optimization is not a substitute for judgment. It is a tool for organizing judgment. Now look at the model. The full mean variance version says this: minimize W, transpose sigma W, minus lambda times W, transpose mu, subject to the weights adding to 1. Here, W is the list of portfolio weights. Sigma is the covariance matrix. It tells us how assets move together. Lambda is the risk appetite dial. Mu is the list of expected returns. And the rule that weights add to 1 means the whole portfolio adds to 100%. The first term is W transpose sigma W. That is portfolio variance. Lower is safer. The second term is lambda times W transpose mu. That is expected return, scaled by risk appetite. Higher is better. The optimizer balances those two poles. The weak link is mu. Expected returns are hard to estimate. A small error in mu can become a huge change in portfolio weight. That is why the stripped-down model matters. Minimum variance says this: minimize W, transpose sigma W, subject to the weights adding to 1. No mu, no lambda, no return forecast. It simply asks one question: what blend has the lowest total variance? This is why the paper is powerful. Even when the noisiest input is removed, optimization still works. It works because correlation and volatility are more stable than return forecasts. The machine can help if we feed it the more reliable part of the data. Pause on that point. Minimum variance is not trying to pick winners. It is trying to remove repeated bets. If a portfolio owns 5 assets that all behave like stocks, the investor may think there are 5 sources of risk. There may be only one. The covariance matrix can reveal that. It can show that the 5 boxes are really one crowded room. Then the optimizer can reduce the crowded room and add assets that behave differently. That is not prediction. That is structure. It is closer to good engineering than fortune-telling. A bridge builder does not need to know tomorrow's wind. But she does need to know which beams carry the same load. Portfolio construction works the same way. You may not know which asset will win next year, but you can still ask which risks are duplicated. You can still ask which risks offset each other. That is why the covariance signal matters. But this paper does not say every optimized portfolio is good. It says thoughtful optimization beats cynical equal weighting. There is a big difference. First, long-term expected returns are still assumptions. They are better than 5-year rolling averages. They are not facts. Second, covariance matrices can be noisy too. When the asset universe gets large, the number of relationships explodes. A 1,000-stock optimizer needs many estimates. Without shrinkage, constraints, or regularization, it can still produce fragile weights. Shrinkage means pulling noisy estimates toward a simpler structure. It is a way to say, do not trust every tiny wiggle in the sample. Third, minimum variance can crowd into the same types of assets. It often likes low volatility stocks, defensive sectors, and bond-like equities. If everyone pays too much for those assets, the trade becomes less attractive. So the rule is not, trust the optimizer. The rule is, respect the optimizer, but discipline the inputs. Use long horizon return assumptions. Shrink noisy covariance estimates. Ban shorting unless there is a clear reason. Cap single positions. Rebalance slowly. The optimizer should look boring when it is done right. That is not a flaw, that is the point. This is also why the best real-world optimizers do not look like textbook monsters. They do not put 80% in one asset. They do not short half the menu. They do not flip the whole portfolio every month. Those are warning signs. A serious optimizer has fences. It has a maximum weight for each asset. It has a rule against shorting unless the strategy is built for shorts. It has turnover limits, so trading costs do not eat the result. It has a slower view of expected returns. It asks whether the input makes economic sense before it trusts the math. That is why Kritzman, Page, and Turkington were not really defending a black box. They were defending a process. The process is simple. Use information that has a chance of being stable. Ignore information that is mostly noise. Then let the optimizer combine the stable pieces. For a modern investor, the trade is practical. Do not choose between blind equal weights and blind optimization. Choose thoughtful optimization. If you have no strong return views, start with minimum variance. Let the covariance matrix do the work. If you do have return views, make them long-term and economic. Do not use the last 5 years as destiny. If you use software, check the guardrails. Are there weight caps? Is shorting banned? Is the covariance matrix shrunk? Are return assumptions stable? This is how many real-world allocation tools work. They combine long horizon assumptions, risk estimates, constraints, and periodic rebalancing. The output can look modest. It may not be a dramatic bet. It may look close to equal weight, just tilted away from redundant risk. That modest look can fool people. They expect optimization to produce something strange. They expect a secret portfolio. But a good portfolio often looks ordinary. It owns stocks. It owns bonds. It owns diversifiers. It has no heroic single bet. The difference is inside the weights. The risky cousins are trimmed. The true diversifiers get room. The noisiest forecast is kept on a leash. That is the quiet edge. That is the paper's quiet power. The best optimizer does not shout. It removes dumb risk. The 1/n rule is useful humility, but it is not a portfolio theory. Kritzman, Page, and Turkington showed that optimization adds value when the inputs are plausible. That is especially true when the model relies on risk and correlation instead of noisy short-term return forecasts. The actionable lesson is simple. Do not blame the machine until you have checked what you fed it.